You keep chasing candles, you see a green spike and you FOMO in. You see a red one and you panic sell. That's exactly why you keep losing, because the truth is you are looking at the wrong chart. Most of crypto retail has no clue how liquidity actually moves, and until you understand that, you are just gambling against people who already do. Today I'm going to show you exactly where the real game is played in liquidity. Once you see how the money moves, every price move will finally start to make sense. Why price is the last to move? Think of markets like a domino line. Everyone's watching the last domino fall. That's price. But what really matters is who's placing the first domino. That is liquidity. Liquidity is simply how much money can flow into or out of an asset without breaking the things. If money can move easily, price rise smoothly. If it can't, markets choke, even if the fundamentals look great. Crypto runs entirely on liquidity, not narratives, not influencers, not even halving cycles. Liquidity decides who wins. Let's have a look at the Fed's reserve repo, the global money tank. Let's see where the liquidity actually starts. The Fed's reserve repo, or RRP, is basically the money parking lot for banks. When the tank is full, it means banks are stashing spare cash there instead of lending or investing. When it empties, that spare cash starts flowing out into the economy, into risk assets like Bitcoin. A year ago, that tank held over $400 billion. Today, it's just $6.9 billion. That's as close to empty as it gets. It's like the Fed squeezed every last drop of water out of the sponge. When that happens, they can't tighten much more. That's when the next phase begins, easing. Rate cuts, quantitative easing, or QE, liquidity injections, call it whatever you like to, but it means money starts flowing again. And when that happens, risk assets like Bitcoin start waking up. So where is the liquidity going? The crypto rails. Here's what's wild. Liquidity doesn't vanish, it moves. And right now, it's quietly reappearing in crypto. DeFi Llama shows stablecoin supply has jumped by nearly $3 billion just this week. That's not random, that's capital reloading. Think of it like traders filling their tanks. They are not hitting the gas yet, but the engines are on. Stablecoins are the lifeblood of crypto trading. They are basically tokenized dollars, and when their supply rises, it means that money is entering the crypto ecosystem. And the biggest engine of all, Tether. USDT. It still controls around 59% of the entire stablecoin market, and historically, every time Tether supply expands, Bitcoin rallies within weeks. Check the charts. It's the same rhythm again and again and again. Tether prints, liquidity enters, Bitcoin wakes up. Now here's the real on-chain alpha. CryptoQuant data shows stablecoin balances on exchanges have climbed to around 64.4 billion, and it's rising. That means traders aren't cashing out. They are parking funds on exchanges ready to deploy. When exchange reserves rise, it's like seeing soldiers moving into the positions before a battle. They're not firing yet, but you know what's coming. If reserves were dropping, it would mean people were withdrawing, exiting risk, but that's not what's happening. They are preparing. Now connect the dots. The Fed's pool is almost empty, stablecoin supply is rising, exchange reserves are loaded. That's liquidity rotating, leaving the traditional system and seeping into the crypto system. It's money leaving the safety zone and creeping back towards risk. And Bitcoin is always the first to sniff that out. Every bull run starts quietly, exactly like this, not when CNBC starts shouting about it, when liquidity silently starts arming itself in the background. That's when the bull run starts. So what's coming next? Historically, when the Fed hits the end of tightening cycle and you see stablecoin inflows like this, the pressure builds for 4 to 8 weeks before the markets break out. If this rhythm holds, that means somewhere between late November and early January, we could see Bitcoin's next real leg up begin. No, it won't happen overnight. It never does. Liquidity works slowly and then suddenly. You won't see it in the candles until it's already halfway done. That is why most retail always arrives late. They chase price because they don't understand that liquidity moved first. And this is the hard truth most of the crypto retail does not want to hear. You keep losing not because you're unlucky, but because you are watching the wrong signal. Staring at charts while whales are staring at liquidity flows. You're reacting to the price, you're reacting to the candles, they are anticipating money movement. The moment you learn to track liquidity instead of candles, you stop playing catch up. You start front running the market and you stop chasing it. And that is the real game. So here's the summary. Fed's reserve repo is drained. Tightening is done. Stablecoins are expanding. Money is reloading. Exchange reserves are climbing. Capital is preparing to deploy. The liquidity cycle that killed Q3's momentum is ending and smart money knows it. Bitcoin's next move isn't if, it's when the liquidity tap fully turns back on. If this made you rethink how markets really move, drop me a comment below and tell me what you are watching. Do you think liquidity is already flowing back in, or are we still early in the rearm phase? I read every comment myself and I want to hear your take.